Silver is one of the most misunderstood assets in global markets. It's volatile, emotional, and capable of explosive rallies, followed by brutal corrections. It's part precious metal, part industrial metal, and part speculation magnet. And because of that, silver behaves differently from almost anything else in finance. In this video, we're going to break down why silver goes up, why silver crashes, the macro forces that matter, when to be cautious, how to think about future price targets using Fibonacci measured moves, and a real-world outlook for 2026 and beyond. Let's get into it. Silver has three major engines behind its bull markets: monetary fear and precious metal demand. Silver often rallies alongside gold when inflation expectations rise, real interest rates fall, investors lose confidence in fiat currencies. But silver amplifies gold's moves. It's like gold on leverage. Industrial demand. Unlike gold, silver is essential for solar panels, EVs, semiconductors, medical devices, batteries. When global manufacturing expands, silver demand surges. Supply constraints. Silver supply is surprisingly tight. Most silver is mined as a byproduct of copper, zinc, and lead. Miners can't easily ramp production. Recycling is limited. When demand spikes, supply can't respond quickly, creating explosive upside. Silver's crashes are legendary, and they follow a pattern. Rising real yields. Just like gold, silver hates rising real yields. When investors can earn positive real returns on cash or bonds, silver loses appeal. Dollar strength. A strong US dollar puts pressure on all commodities, especially silver. Industrial slowdowns. Because silver is tied to manufacturing, recessions or slowdowns hit it harder than gold. Speculative unwinding. Silver attracts traders, not just investors. When momentum breaks, leverage unwinds fast, leading to sharp drops. Case study: 2011 silver bubble. Silver surged to nearly $50 during the post-crisis commodity boom. Then it collapsed more than 70% as real rates rose and the dollar strengthened. Case study: 2020 pandemic spike. Silver doubled from $12 to $29 in months, but as stimulus faded and yields rose, silver corrected sharply. Case study: 2022-2023 volatility. Silver repeatedly failed to break above $30, showing how strong resistance can cap rallies. These cycles teach one thing: silver's upside is huge, but so is its downside. Let's look at the forces shaping silver today. Industrial demand is growing. Solar installations and EV production continue expanding globally. This is a long-term structural tailwind. Real yields are volatile. When real yields fall, silver rallies. When they rise, silver stalls. This tug-of-war is active right now. Dollar strength is a headwind. A firm US dollar has capped silver's upside in recent months. Supply growth is limited. Mining output is not increasing meaningfully, a bullish factor. Investor sentiment is mixed. Silver is not in a mania phase. That means upside potential exists if macro conditions shift. Silver tends to struggle when real interest rates rise, the dollar strengthens, manufacturing slows, inflation expectations fall, and momentum breaks below key support levels. If you see these conditions lining up, silver may be entering a correction.
Let's talk upside. One of the simplest ways to estimate potential targets is the Fibonacci 100% measured move. How it works: identify the previous major bull run, measure its size, apply that magnitude to the current breakout. The 100% extension gives a potential target. Current example: Previous run, $42 to $85 equals $43. Current breakout base, $79. Target, $79 plus $43 equals $122. This aligns with many analysts who see $115 to $130 as a realistic upside zone if macro conditions turn supportive. Higher extensions of 161.8%. If silver breaks above $122, the next Fibonacci extension points toward $148, indicating the historical highs. This is not a prediction, it's a framework. Silver is emotional. You need rules. Here are common sell signals. Price hits a major Fibonacci extension. Real interest rates turn sharply higher. Dollar breaks into a strong uptrend. Silver fails at long-term resistance like $122. Momentum indicators roll over on weekly charts. Silver rewards discipline and punishes hesitation. If you want to understand silver in any decade, focus on real interest rates, dollar strength, industrial demand, supply constraints, investor sentiment, inflation expectations. Silver works best as a hedge, a diversifier, a tactical trade. It works worst when treated like a guaranteed moonshot. Silver doesn't rise forever. Silver doesn't crash randomly. Silver responds to confidence, real yields, and global growth. If you understand those forces, you can navigate silver markets in any era, whether it's 2026, 2030, or beyond. That's today's breakdown. Tell me in the comments, what's your silver price target for this cycle? And before you go, I've also built an ETF portfolio that I track publicly. If you'd like to see how it's performing, you'll find the link down below. If this breakdown helped you understand silver more clearly, give the video a like and subscribe to FinEd for more macro insights without the noise. Thanks for watching, and I'll see you in the next one.